Welcome to the second part of an engulfing pattern of this episode 3, is the engulfing pattern. So we talk about in the first part, we talk about the different variations or varieties of engulfing. I mean, different forms in which engulfing can be represented. So you have to master it. You can print it out or draw it out in the paper and place them, behind your desk or whatever, so that you don't miss out on the pattern. How to identify the patterns in the chart. How to identify the pattern in the chart. Let's quickly do that. How do you identify the pattern in the chart? How to identify the patterns in the chart? Let's change this to candlestick. So here we have a engulfing here. This is engulfing. You can use we can use a pounds Japan that it's not be like only this thing we are doing since Japanese yen, pounds Japanese yen, pounds Japanese yen, this pounds Japanese yen. Then we have here, let's cut it out from here. Let's imagine this is where we were right now, right? This is where we come to be. This is where the market has given us this setup. So what you need to do is to mark out, is this a bullish engulfing? I will not mark out this place like this. For me, it's too high, it's too large. It's too large. What I will do is, this is engulfing zone, right? But if you are comfortable with it, fine. So if you are comfortable with it, this is fine. That's fine. This is engulfing zone. This is engulfing. As long as this candlestick engulfs this, it's engulfing. This is bullish engulfing. This is bearish engulfing. As long as this candlestick engulfs here, we have this as bearish engulfing. And price tap into it and comes down. This is bearish engulfing, bullish engulfing. As long as you see the variation here, as long as we have this, this in there be engulfed by the body of this candle. Can you see it? You don't need to put this one with it. This one is okay, so it's not be too large. And price tap into this zone and went higher. That's engulfing. That's engulfing for you. That's engulfing. So you mark them out. Because you are waiting for price to come into the zone. Yeah, you mark them out. Here, price does not come into the zone here. There's something here. This is a gap, which we're going to make mention of. We're going to talk about right now. This is engulfing. That creates a zone there. This is a rally-based rally. Rally-based rally. Call it in supply and demand stuff. So this is an engulfing zone. You can see the way I'm marking out my engulfing zone. This is an engulfing zone. This is daily charts. Engulfing zone. Engulfing zone. This is engulfing zone. Right? But here we have another type of engulfing that we call a failed engulfing. Maybe we talk about that. Failed engulfing or flipped engulfing. Flipped engulfing. We have the regular engulfing pattern. Then we have what if engulfing fails? When engulfing fails, what happens? That brings us to another type of engulfing named as either failed, or I call it as flipped engulfing. Flipped engulfing. If this is a bullish candle, then we have the bearish candle like this. Probably the body of this went up like this. If this is the wick, then we have this, right? So yeah. So now this is engulfing. When you mark out like this, when you mark it out like this, now we expect price to do what? We expect price to come into this zone, to sell from that zone and start moving downward, right? This is our intention. But what if that intention fails? Our expectation fails. The market fails our expectation. What happens? If you see this, price was moving up higher. Price was moving up, going up, like that, like that, like that, like that, like that. Instead of price to push higher, it starts moving up, start going up, to touch zone and move up higher. So this is a breakout. It's a breakout of this top of the zone. It's a breakout. So here we say engulfing has failed. Failed engulfing. We say engulfing has failed. So it has now become what? It has now become a flipped one, a changeover into a buy, no longer sell. So you are now buying, you are no longer selling because this engulfing has failed. It ought to deliver a selling market, but it failed to deliver a selling market as long as price broke through it and closed above it. Either with this candlestick like this, you have a close like this. When you have a close like this, this become a failed engulfing. So the next candlestick will come down to retry it. You don't remove it. You don't need to remove the DC. You don't need to remove the zone. You leave the zone as it is because you are going to use it to buy when engulfing fails. When engulfing fails, you are going to use it to buy. So you buy when you see price move into this zone and you buy into it. You buy into it. You buy into it. So we call this as what? As a flipped engulfing or failed engulfing. Flipped engulfing. Engulfing zone. Flip engulfing zone. When we come to trading plan, you'll be able to see how we trade that. This is a flip engulfing zone. This is the flip zone, the breakout zone. This creates the high of the engulfing zone. This is the resistance. Then it comes back into it to become a support, to hit the support level, and that starts moving higher. So that is that. Then the other side is the opposite. If you have a bearish or bullish engulfing pattern, if you have bullish engulfing pattern with this candle like this, you have this, then probably you may have something like this. So what you need to do is you want to mark out this zone, right? You want to mark out this zone, looking for price to come into it, right? So this is a engulfing pattern, a bullish engulfing pattern. So that means price ought to, our expectation the price will come into the zone. So we buy into it, moving higher. But if that expectation fails, if it fails to deliver, what happens? It will turn to what? It will turn to a selling market. When engulfing fails, you trade it in the opposite side. It turns like this, turns to this. And turns to this. Yeah. So if it fails, once it fails, you have a breakout, a candlestick that takes out the low of this engulfing. The low of this zone is taken out, which is this, with a close below it, not with a wick. Please note that, not with a wick. You want to see a close with a body above it. That's a volume. The body, the body represents a volume. So you want to see a wick close below it and above it. So that's a change in hand. To confirm a change in hand. Yeah, a change in structure. So there's a change in structure now from bullish engulfing to a new bearish engulfing. It's a change in hand. Can you see now? This has become the new bearish engulfing now. It has become a new bearish engulfing. Yeah, a new bearish engulfing. So that when price comes in, this one has failed, price will tap into this new zone. If you tap into this new zone, price will start moving higher, tap into this new zone. Price will tap into this zone, and then start selling down. Because this new engulfing pattern will be pushing it downward against going up. You start selling down. If you start selling down, to start selling down. So you are no longer buying, you are selling. You are selling from here, from this new zone. Now you are selling from here. You are selling from here. So when we get to this, we will be able to know the trade plan, be able to know how to trade the flip zone. So that's another second part of the different type of engulfing. We have the hidden engulfing, we have the regular engulfing, which we have really dealt with. Then we have the flipped engulfing. The flip engulfing. The flip engulfing. Flip engulfing. That means when engulfing fails. When engulfing fails like this. This is the stuff, right? You're supposed to click here, because this is a zone. This is a zone, right? This is a zone. If this is a zone, supposed to click here and move higher. And move higher. But instead of that, it breaks through it and close below this level. Then start moving out, then come in. Okay. So you change, that's a change in direction. Change in direction of the previous trend. It's a change in direction of the previous trend. It's a change in direction of the previous trend. So this become what? This become your new engulfing level. Yeah. So we call this place flip. So the opposite is for buy. If you have a this is bearish engulfing. This is supposed to be price will come here, then start moving downward. It's from the zone. This is a zone, right? This is a zone. This is a zone. But instead of that, it comes here, like it breaks out of that, the high of the zone, then comes into it. So you are looking to buy. You are no longer selling because price has changed its direction. You are no longer selling because price has changed its direction. You turn to buy, right? So that is that for flip engulfing. We can see it here. We'll see it in this place. This is flip engulfing. Can you see flip engulfing here? This is a flip engulfing. This is a flip engulfing. Can you see price? Instead of price moving down, 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 down to give you your expected profit, it breaks through it. It breaks through it with a close. Come back into this. So this is a retest. So you now buy from here above. You are no longer selling. You are no longer selling. But because if you watch here, in between here, we have we have our bullish engulfing here that initiated this move. Can you see that initiated this move? Bullish engulfing initiated this move in against to what this guy did here. So this becomes a flipped engulfing. This becomes the regular engulfing, bullish engulfing. This is a flipped one or a bearish engulfing, right? When price break through it, become a flipped engulfing. This place. This place. So we use it as a this thing. Now this is a bearish. Also, this is a flip engulfing. This is a flip engulfing here. Initially, price was coming down like this. Maybe I should just And you see that initially price was coming. This is our this is our original plan, right? But let's see what price did. Let's see what price did. Price broke. It went upward because we were to sell. Once you get to this zone, right, we were to sell downward. We were to sell downward. But what happened? And you see, it broke through it, got to this high. You see the big move. The big move. The big move. It breaks above this place, above the high of the distance. So it's no longer a failed engulfing. It's a failed engulfing. They create another this thing here. Right now, you are waiting for it to come down here into this zone because it has become a flip distance. So we want to buy from here, from this zone now. We want to buy from this zone, no longer selling. We want to buy from this zone. It has created, this has become a strong high. Why this place has become a weak high? Because it has been taken out. So this place become a strong low. Why this place become a weak high? Because this strong low was responsible. This thing here was responsible for the taking out of this engulfing. So it becomes a very strong low. So it takes it out. But here now we have a strong high because of what? Because there was a displacement coming down. So if it took down this place now, this place becomes a strong high, this becomes a strong low. But for now, this is a strong low because it has never been taken out. Until when it is taken out, before we can now say, conclude that it is a failed low or a weak low. So price tap into this. Price start to create another, it doesn't enter the zone, this thing. But probably maybe we did not. That's why I say sometimes you can have a disadvantage if you don't put your this thing very right. You can have disadvantage. You will have if you put your this thing right, you have maybe like some few pips miss there. You will have come into your order to pick your order. To pick the order. So we have the new this thing now. We have a new engulfing, a zone, right? If this place try to push above here, close above here, this place become a strong low. This place become a failed high, because it will be taken out. It become a failed or a flipped engulfing. So we are using this right now as a bullish engulfing zone. If market comes into it, we buy. Can you see that? Market comes to that, we buy. So, but you take note of this place. Take note of this place. It's trying to create another this in there. So that's how to use a engulfing. You can use a engulfing to scalp the market up and down. So our target will be to target that high or go to a higher time frame and see the nearest high. So it does not break. It does not close below the low. As long as it does not close below the low. So we have our trade intact. And you see that we meet your first target is taken out. The price breakthrough. So this place now become what? It's now become your what? You are buying again. You can see you can use this opportunity to do what? You can use this opportunity to set your DC up and down, up and down. You bought there at the same time. You are using this as a continuation pattern to re-enter buy. Continuation pattern to re-enter buy. See, all these are new retest of this. This is a gap. This is a gap. So that is so you can go to your chart, open up your chart and see engulfing being retested, engulfing taken out as failed engulfing, and engulfing being retested. Like this place now, this is engulfing, and price tap into it and comes down. This is failed engulfing. This is failed engulfing here. Failed bullish engulfing. It was broken through here. was broken through. It was broken through here. Hmm? It was broken through. After breaking through, because this place was responsible for the breaking of the CP, it becomes a high, and price continues to zigzag. You have moved into the zone, and what do you see? Sell. You will have put up your sell signal there. Then this is a very bullish engulfing pattern. So that is how to. That is the effect of engulfing pattern in the market. Then we go straight to the hidden engulfing. Hidden engulfing, I told you, is when you have a two candlestick, one like this, then the other one push like this. Yeah. So then probably you have an upper wick here. You have an upper wick there. Then you have here a lower wick, right? So you want to do what? You want to trace this place into the high. If you go to a lower time frame to see the engulfing, if you go to the lower time to see engulfing, you will see something like this. Because this is what is being interpreted in the lower time frame. One price move buyers move up, create a high. They create a high, but they got being rejected. They got being rejected downward. And you see that they got being rejected down to this level. The next candlestick opens there and comes lower again, push it lower again to this level of low. Then finally, you have buyers continue the journey from there, breaking through in that level, that previous high. They broke through it and end up becoming like this. So this place has now become what we call a refined engulfing zone. So this place becomes a refined engulfing zone. We are going to look into charts to see how this forms, yeah, and how price reacts, going to react to it. If you have it as a bullish candle, as a bearish candle, then the next one opens lower, right? The next one opens lower. Then you have your wick. This is the lower wick. It could be smaller, it could be longer. Doesn't matter, as long as it possesses a wick. As long as it possesses a wick. So what this information tells us is this. This is the high of that upper wick, and this is the low of the lower wick. So if this is a higher time frame, if you got this in a higher time frame, like 4 hours or higher time frame, HTF, higher time frame, you got this in a higher time frame, this is a higher time frame, while in your lower time frame, LTF, lower time frame, refinement, you want to see a breakout structure in a lower time frame. A lower time frame breakout like this. I want to see a lower time breakout. So what happens that the price were coming down. If you go to lower time, this is how it will be interpreted. It will be displayed. So for you to know that it's a hidden this thing, it makes a low there, then pushed to close here at this level, close here, right? As it closes there, it closes there. The second this thing here, the second candle opens and pushed higher to this level of high. It starts coming down. Sellers will try to battle it down to this low, lower low, to this new low. So this place has become what we call a engulfing zone, engulfing zone, engulfing zone, and engulfing zone, which was hidden in a higher time frame, engulfing zone. Could it be an engulfing flow that was hidden? And so you want to see price move into this place and do what? Price must move here. Price will move here and start coming down. That's what it takes. Here, price will move from here, price will move here, and then going up. That is the logic. So whenever you see this in a trend, please take note, take note, take note. Now, for example, this place now is a kind of a hidden engulfing zone. Hidden engulfing zone. When you see it be retested, this is a hidden engulfing zone. And you see the candlestick, it could come in a different range as long as this place has a weak, a dodgy or a tiny this thing. It's still the same thing as gap, because these are insignificant candles. They represent no volume or low volume markets. This is impulse. You must have an impulse. First candle must be impulse. The second one too must be impulse. If there is no impulse, you have a weak candle in between. If you have a weak candle in between, something like this, you have a doji or a series of a spinning top. That indicates what? That indicates a low volume market. Yeah, a range, low volume market. So it's still considered as a hidden engulfing or a gap SNR. It's still considered as. You can have this as like three of them, like what you have here. This is a low range body. This is an impulse, this is an impulse. So this is what we call in supply and demand, we call it a rally based rally. So that's how to identify this thing. If we refine this place lower now, if you circle it out and you refine it lower, you will see that you get something like this pattern, a zigzag. You have something like this. You have something like this. That this price is reacting to. Yeah, you must have something like that. So if you take it lower to like maybe like 2 hours, let me check the date. That's on the 6th of June. On the 6th of June, like 2 hours or 1 hour. The 6th of June. Yeah, so this is it. That's the place we circle out, right? You can see it. You can see the zigzag formation. I see the zigzag formation. Price move higher, come here, and this place, it comes into it. So once you get this, it helps you to lower your risk level here. So because you are going to mark that place out as what? As your bullish engulfing. And price will tap into it, this bullish engulfing, within that gap range. And you see that. So that is important for you to refine your chart. That's important for you to recharge your point. This is a gap too. Can you see it? So this is a gap too. A gap. So this is a gap. See that you can refine it to lower. Let's see the one that is closer. That will not be disrupted. You can find in different time frame. Doesn't really matter the DC. But the higher the time frame, the better, the more significant it is. Yeah, more significant it is. So you can find it in a different DC. Yeah. Let's watch for find it different. Yeah, something like this. Have this. This is a gap, right? This is a gap. If we select circle out to this place, Let's apply this with these 2 hours. We go to like 30 minutes. Let's see 30 minutes. What happens in 30 minutes? Yeah, you can see the move here. Then you can still go lower to 50 minutes. So see that move in 50 minutes. Yeah. So you can see the engulfing there. This is the engulfing inside. See the engulfing. Wow, powerful. See the engulfing inside. This is the engulfing. So you mark it out. Mark it out. Mark it out. Hmm? And you see it's inside that edison and what happened? Oh la la. See, price tap into it. You can imagine what you are getting here. You just put up your short this thing and you know, and you target what you target this low. Hmm? You target this low and price tap into it. And you can imagine price tap into it and it please your order. You have almost about times 10 risk reward ratio, because you're able to narrow it down. That's a chart. That's a refinement for you. Be able to narrow it down into a lower time frame. Yes. Be able to narrow it down to refine it to a lower time frame. That's why you got that this is there. I see the advantage of refining your, they help you to reduce your risk of entry. Yeah, this a gap. This a gap. So whenever you see this thing like this, and you see coming behind it, this is a gap. So that's for that engulf. That is for the this there. Then we go straight into the next topic. I believe you must have understand do other come to time with our this in our varieties of engulfing. I told you the regular engulfing pattern, then the failed engulfing or flip engulfing. That when engulfing fails, that's when price break out of the zone. You know, against the expectation of your direction. So you change over. You change over. Then we have the hidden engulfing. In the manner we're able to do some justice, so a lot of this into that in the manner. Uh, yeah, in the manner, be able to do justice to that. I think I forgot to but I'm able to do the so this is what we refine here. Can you see that we have a gap here? Then when we refine it into this is 4 hours, we refine it to 30 minutes. This is what we get. This is the entirety of this red rectangular box represents the hidden engulfing in 4 hours. But when we refine, we're able to get this smaller engulfing top, and we have a good cell here, very good cell. And we have this second one again. This one and this one is here. So we have this second one again as a good opportunity to sell at a lower risk, the low risk. So that's engulfing for you. This is a gap. This is a gap. We have an impulse followed by a range, then an impulse. Rally base rally, and a doji in between represents indecision markets. Yeah. So and price tap into it and go higher. So that means if you refine this place now, you get what? You get something like this. You get something like this zigzag. So price will come into the zone and tap into the move, start moving higher. So that is what it represents. Then we have this as a failed, this is a flip engulfing. And you see that this is a flip engulfing. The price tap into it. Then we have this as a bullish engulfing. Price tap into it and moves higher. We have this as a failed engulfing. Price tap into it and moves higher. Failed engulfing pattern. the zone here, we draw the zone forward, price tap into this zone and move higher. This is a failed engulfing when it was broken upward. Just like what happened, here, right? So that's the timing your trade. So you can use engulfing to time your trade, especially when a new market opening or session. During the new market opening session, you can use engulfing. You know, when price tap into the zone at New York time or London opening session, you can use engulfing to your advantage, because that's where you're going to see liquidity, right? Yeah. So price tap into this place and move. This is a engulfing zone, right? And it moves higher. It moves higher. Yeah, it has been taken out. This is a bearish engulfing pattern. It was broken through. It becomes a what? It becomes a new level of a pattern. This is a flip. This now become a flip engulfing. So that's why price come here, tap into it, and then move, start moving higher again. So that is engulfing for you. Maybe when we come back, then we'll talk about how this is the trade plan. The trade plan. When we come back, we'll talk about this trade plan. Talk about this trade plan. Entry confirmation. We'll talk about entry confirmation, the setup, right? Before we go to finally into trend line. We'll see how more is it to do there. So that we go to trend line. Let me see what other things we have. So trade plans, yeah. So we've talked about this. So when we come back, we'll